Hello, welcome back. We need to take a little bit of time to talk about ARKK, the ARK Innovation ETF, which I have long told about how dangerous it is to invest in. Now, look at this year to date return, minus 30%. The ETF has been absolutely crushed. Now, I don't just look at this and go, it's uninvestable, because if it's a good instrument, a good investment, it doesn't really matter what it has been doing over the year. But what I do care about is actually examining what this ETF is holding, and I have made a lot of videos in the past. I wanted to make a short one just to explain why this sort of thing is happening with ARKK and where the ETF is actually sitting right now, being so low in terms of its net asset value. Now, if we take a look at the top 10 holdings of this ETF, you will see that it is Tesla, Coinbase, Teladoc, Roku, Zoom Video here, Block, and some other companies of this sort. Now, Tesla, for instance, if we go back to our tool here, you will see that it is sitting at $880 right now. It goes up and down quite a lot. It's a very, very volatile stock. And this is why you will see its P ratio, for instance, going up and down by the day. And if you take a look at different days, you may see it 150, 200, somewhere around that range. But the point remains, this P ratio, this price to free cash flow ratio is very, very expensive, very, very lucrative for purchasing the stock right here. And the company, of course, because of that, because they know that the stock is overpriced, they have been issuing shares like crazy, of course, to fund their operations. And so holding this company is extremely dangerous, and even though it has been going up quite a lot, there will be a point where it will come to its senses, and you don't want to be around for when that happens. And especially having bought at a very, very high value, like $1,000 or so, that would be insane because it can go down quite a lot if it actually corrects to where it should correct. And some people are saying, okay, I am buying Tesla, an amazing company that is not even a car company, it's like a tech company. Okay, let's take a look at this one. When you are any company, what's the most important attribute that you should be having if you are following an industry? Well, that is margins, because different industries make different margins, and typically speaking, car companies make relatively low margins, while, for instance, a tech company makes high margins. So there is an argument about Tesla being a tech company. So let's take a look at what the margin is of Tesla. So Tesla's net income margin is 10.25 as reported in 2021. So 10.25%. Now let's take a look at Microsoft. What is Microsoft's net margin here? And if we take a look at Microsoft here, you will see that their net income margin is 36%, way higher, three times as much as Tesla. Okay, maybe it's a coincidence. Let's take a look at Apple. So Apple here, AAPL. Let's take a look at their margin. Maybe it's a coincidence, right? So Apple's margin, 26%. Okay, so let's take a look at Ford, which is a car company and not a tech company. What are their margins? 13%, in the range of Tesla. And Tesla's margins, remember, were 10%. So if I go back to Tesla, you will see that their margins were near 10%, 10.25, I believe it was, or something. Yes. So you can see here that if it has the margins of a car company, it is a car company. And it's not a tech company if it's nowhere near this margin. So, again, this is a company that is very, very overpriced. And the same story goes with the rest of the companies for the fund. So, for instance, Teladoc is a company for which I made a video pretty much a few moments ago, like an hour ago or so. It's down 40% today, and it doesn't even have a high P ratio because it's negative in terms of net income, so it's losing money like crazy. And the other one, Roku, for example, is another company that is not cheap. And of course, I have made videos about all of these companies in the past, and I'm examining them separately. But take a look at the outstanding shares increase here. Company issuing shares and shares and shares, massively diluting you. High PEs, high price to free cash flow. It's a very, very expensive company that is massively diluting you, becoming even more expensive for you if you bought that company. And Zoom Video, another one. Let's take a look at Zoom Video. Zoom Video, communications here, ZM is the ticker symbol. Now this one, let's take a look at this one. This one seems a little bit better, although there has been some dilution. So maybe this one is not as bad as the other ones. Of course, again, I have examined all these companies in separately. So this one is probably one of the better ones. We do have to take a little bit of a closer look, but it does look better. And another one that is a little bit better is Coinbase, but again, this one is based a lot on what it's going to be doing in the future in terms of cryptocurrency. It really depends on the market. I'm going to be making a completely separate video about this one, but take a look at this dilution here again. This is very, very important because it's almost as if you're buying 25% less shares from what you bought. It's exactly that, actually. And so it's a good idea to buy companies that are not massively diluting you and doing the opposite, actually buying back shares so that you gain more of an ownership, more ownership of the company that you purchased stock from. So this kind of companies is what the fund is holding, and this is why it's extremely dangerous to be holding this fund, because it can go up and down a lot. It is volatile, and of course any stock can go up and down a lot, but when you go down a lot, you need to be having the free cash flow, you need to be making the net income, you need to be cheap enough so that you can reverse the situation and go back to your normal. But this ETF, because it's massively overvalued, because it's holding a lot of companies that are not doing well in terms of their stock price when you compare them to their stock price, and when you compare the financials to their stock price, it's a disaster, and you can really lose a lot of money if you invest in an ETF, which is pretty much a portfolio of companies that are massively overvalued and they are not producing the expected financials for the price of the stock. It's a very, very bad idea to do so. And I wanted to make this quick video just to note down that fact, because it's been a while since I talked about ARKK. Many people may be seeing that there is a decrease in its price again because it's down massively, maybe thinking about it. I would urge some caution here. I wouldn't enter, of course, this fund even if it's $20 or so. There's no way I'm entering this one. But some of these companies that the fund is holding may be investable for sure. Like Zoom, for instance, as I mentioned earlier, may be one that is investable, and Coinbase as well may be one that is interesting here. Again, we're going to be examining this one in a separate video as well. But be paying special attention because Teladoc being 6.6% is like 40% down today, not looking great. So thanks for watching this video, and I hope it helps a little bit if you were thinking of ARKK. Please be cautious about these kinds of ETFs. And in the meantime, take a look at the video that I made earlier and discusses Teladoc and what happened with the stock. And thanks for watching again. See you soon. Bye-bye.